A fat margin is a term used in business to describe a high profit margin. A profit margin is the percentage of revenue that a company retains as income after the deduction of expenses. A fat margin is typically considered to be a margin of 20% or more. Fat margin, also known as profit margin, is a crucial financial metric used to assess a company's profitability and efficiency in managing its resources. It measures the percentage of revenue a company retains as profit after deducting all costs and expenses associated with its operations. Understanding the fat margin is essential for business owners, investors, and stakeholders, as it provides insights into the financial health and performance of the company. To calculate the fat margin, one needs to subtract the total expenses from the total revenue and then divide the result by the total revenue, finally multiplying by 100 to express it as a percentage. The high fat margin is generally considered favorable, as it indicates that a company is generating a significant profit relative to its operating costs. This allows the company to reinvest in the business, distribute dividends to shareholders, and create a financial buffer for any unforeseen challenges. On the other hand, a lower negative fat margin suggests that the company may be struggling to cover expenses with its current pricing structure or facing operational inefficiencies. The fat margin can vary significantly across different industries. For example, industries with higher costs of goods sold, COGS, such as manufacturing or retail, tend to have lower fat margins due to the substantial expenses involved in producing or acquiring goods. Conversely, service-based industries like technology consulting or software development often enjoy higher fat margins since their costs are primarily focused on personnel and intellectual property. Several factors influence a company's fat margin. Pricing strategy plays a crucial role, as setting competitive prices that reflect the value of products or services can impact profitability. Effective cost management is another key factor. Companies must identify opportunities to reduce expenses without compromising the quality of their offerings. In times of economic uncertainty, maintaining a healthy fat margin becomes even more critical. Companies need to be agile in adjusting their cost structures, exploring new revenue streams, and carefully managing cash flow to ensure sustainability during challenging periods. Comparing a company's fat margin with its competitors and industry peers is valuable for benchmarking performance. Investors often seek companies with consistently strong fat margins, as it indicates financial stability and competent management. In conclusion, a fat margin is a term used in business to describe a high profit margin. A profit margin is the percentage of revenue that a company retains as income after the deduction of expenses. A fat margin is typically considered to be a margin of 20% or more. The fat margin is a fundamental financial metric that provides valuable insights into a company's profitability and efficiency. Companies should regularly monitor and analyze their fat margins to make informed decisions about their pricing, cost management, and growth strategies. Maintaining a healthy fat margin is vital for long-term success and resilience in the dynamic and competitive business landscape.